Can you explain what internet is?
That little mark with the A and then the ring around it.
Your link to literature, the arts, the world at your fingertips.
In 94, 30-year-old Jeff Bezos creates Amazon out of his garage. The same year, Yahoo, a searchable web directory, is launched by 20-somethings Jerry Yang and David Filo.
As soon as I learned to type Amazon.com, I could get my way to about 2,500,000 books, so it was remarkably easy.
Go online at work or while working at home? Next time you're on the internet, go to the new Netscape.com. Faster searches, instant messaging, a customized start page. The new Netscape. Power and ease of use. It's free at Netscape.com.
The dot-com bubble, a high-stakes event of increased investments in the digital world, which led to one of the biggest crashes in history. So, how did it come about? Who succeeded? Where did some fail? And where does it leave us today? The dot-com bubble had many tech stocks and web-based companies rise. Investors flourished due to the mass investor confidence in startup tech companies. The bubble began as many companies begin, with investments. These investments had been rising within the Nasdaq. Among the largest companies on the stock exchange, such as the now predominant Apple and Microsoft corporations. Known to be the largest tech boom investors and venture capital firms have been a part of to date. Venture capital are a group of highly financed investors that seek out privatized startup companies that aren't available to the public. The high influx of investments led to the valuation soaring, giving many companies a massive level of available cash to grow their business. Some companies had little security of financial growth and lack of education on how to use these cash reserves. Investors began taking long shots with hopes of success. But why did these risky investments begin? Why would investors start directing high levels of cash to these companies? As companies began taking advantage of newly found tech, in turn, many news outlets, whether that be web broadcasters or even newspaper-run organizations, made use of monetization, such as revenue derived from advertisements. As you might have guessed, these aren't uncommon from today's practices. Even telecommunications companies became ever profitable, serving to make internet connectivity more accessible for everyone that was making use of the World Wide Web. One of the more beneficial areas of the tech boom was the low cost of marketing measures with the access to the internet. As computers began entering schools, students were educating themselves on the tech. With this access of information, there was also an increase of computer use from 15% to 35%. This was because computers were now lower cost and weren't just limited to high-ranking officials. It wasn't just a luxury item. It was now available at low costs, selling rapidly to anyone. As many investments took place, so too did company values rise, such as Qualcomm, producing semiconductors as well as providing alternative services. Lesser well-known companies, such as penny stocks, also were made use of in order to gain a quick return, so that individuals could invest in more well-known organizations. Investment banks also began taking part, still overlooking technical information, which would have otherwise proven many companies to be overvalued. Regardless, institutional investors still proceeded to fork out cash. One of these metrics would have been the price-to-earnings ratio, or PE for short, which was reaching $200 for every dollar of a company's earnings. To put that into perspective, normally the PE ratio should be up to approximately 15 or 25% to be considered moderately valued. Instead of looking at these metrics, investors based their financing on the means such as how much user traffic was entering specific websites at any given time. Companies burned through cash reserves, causing heavy losses to affect investors. Some tech startups flourished, such as one of the most predominant online retailers today, Amazon.com, which started off as a mere book retailer and is now producing products from A to Z, having achieved $147.98 billion in the financial year of 2023. The boom in turn had many taking actions with a lack of education and financing, causing misuse of resources. Being unable to keep up with competition led to further bankruptcies across nations. As prices of these companies inflated, it had led to mass sell-offs of stock ownership, in turn making those that short the market even richer. Alan Greenspan, who was one of the most reputable chairmen of the Federal Reserve, coined the term irrational exuberance. But what exactly is irrational exuberance? It is a term indicating investors overlooking company fundamentals and instead basing investment decisions on enthusiasm. As Greenspan stated, how do we factor that investment into monetary policy? Many taking this speech as hints of a potential bubble bursting In turn, this led to mass sell-offs taking place and stock prices plummeting, leading to panic selling, causing prices to drop further than expectations. Companies that survived the crash took advantage of lesser-known sectors or even at a scale that was unprecedented before. Although many companies ran out of cash reserves, in turn, many had enough to achieve self-sufficiency, meaning that even though their cash had been depleting as those before them, their revenue was enough to serve as a cushion which enabled them to move forward in the coming years. One of the silver linings that goes beyond the crash is that the internet had not been discarded entirely. Such companies that survived was Apple, by incorporating software across mobile phones to have access to the web. In a bite-sized summary, the dot-com bubble was a time in history where there was great excitement due to the innovation and access of new tech. This excitement led to many venture capitalists and other individuals investing heavily in the technological sector, even in companies that were more speculative. These investors were overlooking company fundamentals and investing purely on feelings of optimism, and hoping not to miss out on potential gains in the corporate world.